Hi everyone, this is a brief overview of what is needed to start as a trader. Hopefully it gives some good tips and ideas on what to do before you start rushing in with all those buy signals. With trading, just like any other profession or sport, to be successful a person needs to be prepared. That means you need the right tools, the right routine, the right understanding and good practice before you really begin. So what is the right setup? Let's go through a 5-point checklist of the minimum you need before you start. Here's the overview of the presentation. The 5 things. Number 1, understand the instrument. Number 2, have your software ready. Number 3, determine your account size. Number 4, choose a methodology. And number 5 is determine your trade size. So let's go through the detail of each one. So the first thing you have to do before starting your trading is you have to understand the instrument. So what are you trading? Is it a normal equity? Is it a spot commodity? Most important, how does your broker offer this product? For example, if I trade the S&P 500 through one broker, every 1 point move is $50. But if I trade the same market through a different broker, I can show you that every 1 point was only a $1 move. Now that information has a significant impact on all the other points, like your trade size and your account size required. That's why it's so critical to understand exactly how that instrument works with that specific broker. Now CFDs, equities, SSFs and options is another example that might all trade the same underlying instrument, but because of the way they work, the way that you profit from them can be very different. So the most important thing to understand from the instrument is how much you can lose on a move. Notice I specifically didn't say win on a move. Your focus should always be on the losses first. So here's an example on the Aussie. The margin deposits vary between brokers, but they're often around 30 to 40,000 Rand per contract. So that's the bare minimum required. Then once I bought a contract, a 1 point move represents 10 Rand. So I understand that if I go long at 40,000 and the Aussie moves to 41,000, that 1,000 point difference means a 10,000 point profit. Of course, if I was short for those 1,000 points, the difference means 10,000 Rand loss. The Aussie does not involve share splits, dividends or interest, so that answers the other questions. It's very simply how many points times how many contracts times 10. Because it's geared, that means it's a deposit I put down, not the full amount. That means that there's a chance I can lose more than I've put down, or losses can exceed initial investments. Example 2 just quickly looks at normal equities. There's no gearing, so the most I can lose is 100% of the investment, which is better than derivatives where I can lose more than that. Stocks are made up of both capital growth as well as dividends received along the way, so that helps me understand it a bit better. Moves can be quite large and small on stocks. For example, penny stocks or growth stocks can move more than 100% in 1 year. Software. Now next we need the right software to help us trade. This is the scouting you now need to do to help determine which broker will provide you with the necessary software. At this point it helps to think about how you trade and what's required. For example, is it charting software you need, or is it access to fundamentals like dividend payouts or balance sheets? The brokers range over a vast spectrum with what they provide, as each of them target different audiences. By doing so, their fees also vary quite a lot, and fees are a killer of any investor and trader. So you'd want to look for the broker that provides reasonable fees with the software that works for you. Here's just some screenshots of different software that's available. In this one it's Emulator Broker, which I mostly use offline. as I import data and then I add my own indicators and analyzing tools. The software allows me to code and backtest on old data as well, which is helpful for a systems trader. Other brokers I've seen don't allow you to code your own indicators and only provide a preset list of indicators, and some brokers I've seen don't even provide charts. So here's another example. It's Metatrader. It's quite a commonly used bit of software by most forex brokers. This software is very commonly used amongst algo traders as well that trade with robots, or also known as expert advisors. It also easily allows you to add your own indicators just like Emulator Broker, and then it's got some basic tools like fibs and lines for the technical analysts. At point number 3, we look at your account size. How much do you enter the market with will differ between each person as their financial circumstances differ. So there's no way to tell you a specific amount. However, here are some tips that will help you determine the right size. Firstly, what are you worth? If you're worth 100,000 Rand, for example, now this is all assets and liabilities included, and you require 40,000 Rand for the margin deposit for an Aussie, that means you're going to enter this business with between 40 to 60% of your money. From personal experience, the higher the amount you deposit, the more stressful trading becomes. Trading should not be a big part of your assets. You should play small, but aim for big returns. Another tip is to look at your system or methodology. When a trade doesn't pan out, what kind of risk do you look at? This is easier to determine with systems testing, as you get a good overview of the past years, what the system does and what an average trade looks like. But on discretionary investing, you could also have some manual rules, like I never risk more than 10% on one trade. How will this determine your trade account size if you have 3 losers in a row? It's just something to think about. Finally, one of the most critical pieces of the puzzle is what is your methodology? In my opinion, one of the crux reasons why so many traders fail is because they keep changing from methodology to methodology, or they simply never had one to start with. I found quite a lot of people that believe reading the latest magazine or newspaper is an easy answer to the markets. The range on how you trade is vast, but essentially it comes down to one of 2 ways. It's either technical based, so it's based on the charts only, or it's based on fundamentals, anything off the charts. And then alternatively, you obviously get the mix of the 2. There are successful traders in each group. No one methodology is better than the other. What is consistent with successful traders, though, is that once a trader has found his style, he sticks to it consistently. Each successful trader is also able to answer the question in their sleep. When do I buy? When do I sell? When do I close in a loss? When do I close in a profit? That's my problem with reading a newspaper on the latest stock picks, is that there may be great buy signals, but they never really tell you when to sell, especially if it's not panning out. So in the end, when it's not going well, you sit like a deer in the headlights, frozen, watching your money disappear and not knowing what to do. It's also the problem that I have with the buy and hold mentality, as there are numerous cases where I can show you where it didn't work, and these aren't just on individual shares. There are many methodologies, and here's just a few to show. But a book to read that's really interesting on this concept is the book Market Wizards. It's one of my favorite books of all time, as it helped me understand how different successful traders carved their own way through the jungles of trading. Finally, the trade size refers to how much you enter on an individual trade. So it's what portion of the total account size you place on each trade. Do you go all in on one trade, or do you limit it to 5 at a time? Do you use a 2% stop loss or a 5% stop loss or 10%? You need to be able to answer this question. How many contracts or equities will I buy on this trade before I enter? To end with an example of how to use this checklist, let's have a look at the late great Sir John Templeton. Just after World War II was announced, the stock markets crashed. When others saw panic, he saw opportunity. He took roughly $10,000 and bought as many $1 stocks as he could find, knowing that at some point they will recover again. Well, at least some of them. So let's go through this checklist. So point number 1, understanding the instrument. He bought vanilla equities. Did he understand what vanilla equities were? Yes, he did. Point number 2, his software. Well, it really refers to his means of getting information. In 1940 there was obviously no electronic software, but he checked his investments at the bucket shops regularly. Point number 3, account size. He opened an account size with $10,000. He was happy with that amount, he took the risk. Point number 4, methodology. Did he have a methodology in place? Yes, he did. He knew when to buy, it was at that point in time. He knew when to sell, it was after the war. He knew which shares to pick. He filtered them out with shares that were trading at $1 or less. And then it was simply buy and hold and see which ones panned out and which ones didn't. And point number 5, the trade size. He allocated $100 on each trade, so that's why he bought 104 stocks. This presentation should give you some guidance on what are the bare minimums of what's required to be a successful trader. Within these key points there's a lot of detail as well. It's easy to say that you need a methodology. However, one can research the perfect methodology for years before settling on the right one for you. Always remember though, be careful on the markets, play it small and play it safe, and aim for small sizes with big returns, which grows your account organically. So that was the whole presentation. Thank you very much for listening. Cheers.